Hello, everybody. Kirk Spano, Retirement Income Options and Stocks of the Week on Monday, March 11th, 2024. I had a big weekend. I got a big week, so I'm going to make this kind of quick today. However, I think there are some things that you ought to really be looking at with your portfolios. All right, Shooter posted something today that funny, I was going to use the title, We Have a Divergence in the Force, use some Star Wars stuff. I have the article started and I want to incorporate some of Shooter's stuff. What Shooter is saying over at Fundamental Trends is that there is some notable bullishness left in this market. However, I think that this is kind of a last puff before a breather in the market. And I think that any bullishness to the upside you see in this next week, you really ought to take a chance to trim. If you haven't written any covered calls yet, I honestly think you should be doing it now, like either as we're on the call or as soon as I get this published. I've been telling you for 2-3 weeks, write some April, covered calls, maybe even May covered calls on positions. And I don't think it hurts to trim back overbought large caps. I think that there's a lot of overbought and probably overvalued large caps out there that you can trim. And we're going to use a special guests article today to take a look at a few things, because I was surprised to see that Dividend Sleuth wrote an article. And he did, so I put some notes on it, and we'll get to it in just a minute. In any case, the dollar really is not doing a whole lot at the moment. It has dipped just a little bit. I think that if we get mean Jerome Powell next week, and in particular, if we get a hot inflation number tomorrow, this dollar could pop right back up. And if the dollar pops up, that means stocks go down. So the inflation number on Tuesday is pretty important for the short-term trader narrative. But I think the bigger trend to keep an eye on over the course of the year and into next year is a weakening dollar, because I do believe that at some point you're going to see the Fed loosen up. They've said they're going to loosen up. When they said they were going to tighten up, they tightened up. Now that they're saying that they're going to loosen up, you should expect them to loosen up. The pundits come out and say, they won't cut rates this year. Every single one of them is full of shit, and you should ignore them. There will be rate cuts this year. I still think that what the one Fed president said the other day that sounded exactly like I wrote his notes for him is that they're going to start with a 0.5 point rate cut in May, and then they will see how things look in June, and then maybe do another 0.5 point in July. But when they do the May cut, I really do think they're going to explain it a little bit in the way that I suggested, which is, hey, we're just taking that last one off and we want to flatten the yield curve a little bit. And then in July, if they can, they will lower rates another 0.5 point. And that might be it going into the election. They might just lower a point going into the election because they don't want to be seen as being, favorites. So, or showing favoritism. But expect the long-term trend on the dollar, and I say long-term, the next year or two, to be getting weaker. And then, 2026 and 2027, I'm telling you, you could see a significant rise in the dollar back to highs, and we could see a pretty significant bear market in 2026 and 2027. We'll worry about that then. In the meantime, I think there's money to be made as risk assets spread out, as breadth expands. But I think that over the next couple of weeks, rationalize what your portfolio looks like. If the dollar is going to pop up a little bit here and we get 4, 6, maybe 8 week correction into the May Fed meeting, that's your chance to upgrade your portfolio. Do a little trimming so that you can do a little buying. TLT, Shooter likes to talk about TLT because, it's a trading vehicle for him. You see that these are daily charts. He's swing trading this stuff using options. To me, I'm not too worried about TLT unless the dollar gets strong, pushes this down because people have a no interest rate cuts this year moment, and the trader narrative is running over here and then running over there so they can run over there again. So if TLT gets down here, low 90s, and you are a retired investor and you just want some dry powder in something safe because interest rates will go down eventually, then TLT in the lower 90s is kind of your dry powder fund above cash. You could do that. So between cash and TLT, if you really want to be an 80-20 investor, that would be the way to do it. Some combination of cash and TLT is 20% of your portfolio. I don't really see any point in buying corporate bonds. If corporate bonds do well, stocks do better. And if corporate bonds do poorly, that just means they're taking part in a stock correction. So I don't know that there's really any benefit of corporate bonds that are within funds. I've been working with one consulting client that he's got a huge bond portfolio, individually purchased bonds, and it's a lot for me to wrap my head around. But buying individual bonds here and there makes sense. The bonds that are interesting to me right now are New York Community Bank Corp. I just glanced at them. I haven't looked at them too closely. I did buy just a little starter position, New York Community Bank Corp, this morning. I think that it is, I agree with the Bloomberg article that said it's a no-brainer. So I sold puts, which I will publish today. And I also bought a little stock. So not real big, just kind of inching my way in there. But I think that once this stock starts to move up, maybe in a month or two, you'll probably want to pyramid that one up. Shooter mentioned a couple swing trades, so we'll take a look at Spire Global. He's saying that the first wave up here is into the low 20s. I agree with that. I actually sold a couple of $20 calls on Spire just because it had gotten to be such a big position that at 20, I'd be willing to sell just a little bit of it. That will also be in the retirement income options article. When it pulls back to about where it is now, he sees a much higher price. And I think that from a fundamental standpoint, a retrace back to the all-time highs, which would be 70, I believe, or the IPO price, 70, or maybe 80% of the IPO price, mid 50s, is this range here makes a lot of sense to me for kind of the easy money. I think based on the contracts, it's going to get there. How does it shape up? How does it get there? I don't know. However, I think that you're destined to see Spire between 50 and 70. Does it go higher? Maybe. Who knows? We'll see what other contracts they get. But I think it's pretty easy money to that 50 to 70 range. If you're not going to trade it at all, you just wait till it gets up there and then you figure out a profit-taking strategy. I have a huge position in Spire because it's almost tripled since I loaded up back around Labor Day, and I just want to take a little bit of profit at 20 because I know that is a resistance level. If I decide to, I can always sell puts when it gets back down here. Now, he has something in here on Gilead. I haven't even read this. If you own Gilead, especially if you bought it recently along with him, pretty big runway up, back up here to the 90s. And then, you see what happens if it zigzags up. I do think that AI is very good for companies like Gilead, and I don't know how long this ride up to new highs would take, but I think it will eventually get there. But when you take a look at scale, take a look where the price is now to where the highs would be, the next big high zone where these pink bands are. It's not that big of a jump. So I'm not excited about Gilead. There's not enough upside for me. And if I'm wrong about the AI, or if they just don't, if the other companies get ahead of them, not too excited about it. To me, I would rather buy the basket using an ETF when I think that there's a chance for the ETF to outperform the market for a year or two. I think that's the way to go there. Now, here's one that I think is very interesting because I just mentioned Cisco, didn't I? Just a couple of weeks ago, or maybe last week. So Cisco, they are, they have a fortress balance sheet. They pay a dividend, and they are at the gateway now of all things internet, obviously, but they are helping develop Ethereum and get Ethereum into the market. Cisco is one of the two companies I mentioned that I'm pretty interested in because of what they're doing with Ethereum, which essentially is a software as a service replacement. And I think Cisco is going to make a lot of money on that. I think that buying this dip here probably makes sense. They are getting added to the punch card dividend stock list in a few weeks when I do the quarterly update. So I'd start to get familiar with Cisco, go to their website, read about what they're doing in business. The Ethereum, I know people are like, oh, it's crypto. Well, here's the thing. Ethereum's a quarter of the crypto market. Bitcoin is a little over half, and everything else is the rest. Ethereum is the backbone that a lot of other cryptos are actually built on for their specific functions, whether that is to give ownership to real estate, right? To track ownership of real estate. Almost all real estate transactions at some point are going to be using a blockchain because it's digital. It eliminates the need for the title companies. Title companies are getting into this. So this is the future of real estate transactions with the Ethereum. And then if there might be a separate token on top of it, or they might just absorb it, hard to know how the developers work that. I don't think Ethereum is going to ever be like Bitcoin because it's a different animal and it doesn't have proof of stake and proof of working the same way. Bitcoin is you mine it and you own it. Ethereum is it's different how you get it. I don't think that it ever becomes currency like. I think it's more security like. I would think of Ethereum as how it benefits companies versus as its own thing. I just don't see super long-term value in Ethereum, the commodity currency, whatever it really is. To me, again, it's software as a service, and I think the companies benefit from that. Cisco, we maybe are supposed to be buying it right now. I'm a little worried that we get a weak patch in the market. So we might get one more little dip down here to this 8-day. So middle 40s on Cisco, probably a spot to buy it. Could it get all the way down here? I guess. I guess it could get to 38, 39, 40-ish. But, I think the upside is, way up here. I think it's way above 90. I think this is a $100 stock again at some point. And you collect the dividends. So this is for retirees who want a dividend, who want a fortress balance sheet, and want some growth to boot. Cisco is starting to look like a really good retirement stock. So, retirement. Dividend Sleuth posted an update to his retirement portfolio today. I just saw it 20 minutes ago, maybe a half hour ago. So I will say hi, Ted. Glad that you're doing okay and doing well enough to post. I don't see you in the room. That's too bad. Anyway, he wrote an article talking about some things, and he's a retiree, and he bought Nvidia last year. It has roughly doubled his money. Pretty nifty for him. He owns some other things. He talks about wanting Costco. Of course, I just told you to sell Costco because it's overvalued and overbought. But if it drops 30%, hey, buy Costco. Amazon, I like because it's becoming more apparent to me, and I think they're actually setting up for this. The spinoff of AWS is coming. Don't know if it's this year, next year, year after, but it's coming. And when they spin off AWS, it'll just be another giant company. I don't even think Amazon will drop that much in value. I think that you're going to get, a 50% combined increase in the market cap of the two companies versus what the market cap is now together. So when they split it, it'll be worth about 1.5 times more pretty quickly. So he has two baskets, just general dividend payers: J&J, Microsoft, Apple, Procter & Gamble. I wouldn't own Procter & Gamble. Colgate, I wouldn't own Colgate. Nike, Cisco, I'd probably, I like Cisco. CME Group, I like. Abbott, United Health, Bristol Myers, I like. Nvidia, Globe Life. So in this portfolio, I basically just said trim everything back to a 2% holding because you wanted a little bit more cash. And I think that almost everything on this list that I looked at is a little bit overbought and a little bit overvalued. So go ahead and sell them. I just think consumer staple stocks just suck long term, starting about 15 years ago. So it's not like this is a new idea. But if you take a look at Procter & Gamble and Colgate as, compared to the S&P 500, they're junk. Group 2, a lot of REITs, but you know, these are his bigger dividend payers. So I think that this is a group that he should take a look at. Maybe trim all these back to 2% as well if he's looking, or, you know, 2.5%, whatever, just to raise some cash, because he said he was light on cash. And again, almost all of these, if you take a look at the RSI, take a look at the weekly RSI on each one, you're generally going to say, oh, well, a lot of these are, you know, sporting RSIs on the weekly of around 70, which is almost always a sign of a correction. You know, let's just, you know, like the oil companies, I probably wouldn't trim because I think they're getting, I know that they're not overbought, but I don't know. Let's take a look at one. Who do you want to take a look at? Who do you maybe own? UPS. Let's take a look at UPS. So UPS, pull up the TradingView. Actually, I've been getting signed out because somebody changed my settings. I think it was this guy. I didn't mean to, but it happened, and I got to figure out how to put it back. Oh, that's a car. That's a car. That's a car. That's a car. I'm not a robot. All right, UPS. Super charts. So there you go. Move this back. Go back to 2000 and we can do a long-term chart. I mean, see the real consolidation there that took off from, and then go to the last big correction other than COVID, it's 2019. You see, not a super sexy chart, but not overbought either. The UPS, you know, and that's a monthly chart, but a weekly, yeah, I don't think that you need to trim UPS. And this is the same kind of analysis I would do for anything. Take a look at the weekly, take a look at the monthly. Monthly, clearly not overbought, right? So it looks like just from that, you should be thinking, oh, well, if this is going to go up here and pull the monthly up, maybe this is a real good one to just hold for a while. You know, one of the chart patterns says it's ready for a big drop. I don't buy that. I think that play with your charts. You go, okay, what's most likely? Get the pitch fan. Pitch fan doesn't like it either. Pitchfork likes it, and the institutional fair value gap likes it. So there's mixed messages on UPS. If you like the company longer term, there you go. But it has been chopping since it peaked up here after COVID. But that's right about, everything about this just kind of screams fair value. Maybe slightly undervalued. I think it'll take a while to get up here, you know, maybe a year or two. So a jump of $50, make 30% in the next year. See, that's not super sexy for me, but for a retiree to know that, hey, this is a stock that's not overvalued, not overbought, pays a dividend, and it really is one of the essential companies in the economy, this would take the place of a consumer staple stock in my mind. And you can do the same thing for all of those. And again, you know, just to show you, you go ahead and pull up some screeners. We want to add oscillators. There you go. We want to change that to weeks and 8 weeks, but they don't have 8, so we do 9. And go ahead and rate it. Sort descending. And let's make it S&P 500s. There we go. So in the S&P 500, you've got some really overbought stuff here. Anything that you're seeing here, RSI in the 80s, 70s, all of these can be trimmed back. Every single one of them. I'd like to get into Qualcomm at some point, but every single one of those. Weekly RSI in the 70s, yeah, go ahead and trim them back. Or write covered calls, all right? That's why this is such an important tool. All right. What else do we got here for today? Now, BDCs, and I blame the authors at Seeking Alpha partially for this. Everybody's taking a look at business development corps, which are horrifically cyclical. And they just had a cycle where the banks weren't lending, so they got all kinds of new business, and they all rallied up. If you take a look at the BDCs, you know, people go, oh, look, it's paying 10%. Right. But if the stock drops 20, you know, you're pulling out principal. You're not really making a dividend. And I think a lot of these are in store for 20 and 30 and 50% corrections over the next few years. I don't know how close we are. Probably be a little pullback and then a rally and then a big pullback. So you take a look at these. The one that I like the best is Pennant Park. I understand their assets. I think they're undervalued. I think that's why the yield is high. I think that this one probably doubles in price over the next few years. I think eventually people discovered it. It's smaller and it does well. Ares Capital is a good one. So you really, when you take a look at a BDC, you need to go to every single one and say, okay, what are your assets? So let's just take a look at Main Street. Main Street Capital Portfolio. There you go. Like I've been here before, portfolio companies, right? And you have to go through these and see what they all are. That is the true due diligence of doing BDC research. Take a look at all these companies and kind of get a flavor for what their general purpose is, right? And read the about. Okay, what do they like to focus on? They'll tell you what industries they are, and you really want to, try to figure it out. The BDCs that have a lot of restaurants, I'd run away from fast and hard. But the ones that focus on industry and technology, I think they're pretty good. Now, there are some that focus on biotech. Those are super cyclical. You might as well just buy the biotechs. I don't know why anybody would buy the BDCs. It's just a lot of extra risk, and they're taking a big cut. So, there's reasons to buy BDCs, but you have to understand the companies that they're buying. What's AFG? AFG rentals, rent to own financing solutions. I'm not excited about that. I hope that's not a big one. Although they've had it for 20 years, so maybe it's good. So you just go through these and you figure out what each one does. It looks like they have quite an industrial focus. I kind of like that. All right, but with BDCs, don't get entranced by the dividend payout. You really, really have to take a look at the quality of the companies. When the dividend is low, that means that it's probably overvalued. And when the interest rate is high, it could be one of two things. It's either undervalued, like these guys, or it's a shit stock. So you really have to figure it out. Are they a shit stock or are they undervalued? At Pennant Park, they're undervalued. Let's take a look. That's a BlackRock run, so that's probably not shit. Fidus. Okay, what's Fidus Investments? Let's find out. Let's just put it in here. Like, I don't know what all these are, but not a sexy chart. Yeah, came back off the COVID crash. So this is the sort of thing that can happen on a recession. With these, that's why they're so cyclical. See, down, up, down. And there's nothing beautiful about that chart, right? And that's pretty horrific. So what if we get a 3-year bear market? See, they don't go back to the financial crisis. But if we get a 3-year bear market at some point, which could definitely happen at the end of the decade, then all these are just going to get destroyed. So just be careful. They're not as sexy as you think. Pop up their portfolio, or we can't. This one you can't do it easy. I don't like it. Doesn't seem too transparent, does it? Defensible. I mean, they say the right things. Hard to know. In any case, be careful with the BDCs. All right. Any super salad questions today? Right? You ever go to the restaurant, they say super salad, right? Soup or salad, and we just call it super salad, right? Any questions? Going once, going twice. You own any of these? Trim them back or sell covered calls. April or May, pretty much at the money. Collect your premium. Let the time value come to you, right? Somebody asked about Ametis. Ametis just keeps doing everything right, and things just keep getting better. But right now, there's a group of traders shorting it that are offsetting the longs. And as soon as there is a new money manager that starts to accumulate, the shorts are screwed, and it will squeeze way more than it did last year. So the next short squeeze takes Ametis into the teens. If it happens before the Russell rebalancing in the next couple of months, then you maybe see Ametis in the 20s by the end of the year or early next year. If it doesn't happen, right, if they don't get into the Russell again until next year, might have to wait. But there's really like no downside, and the upside is gigantic. So you just wait, right? I mean, that's, I waited 7 years on Exact Sciences, right? Just it chopped along. It was drifting up, but it chopped along. And, there were periods where it didn't go up for a year, and then suddenly it hit the hockey stick. Ametis is either months or about a year away from the hockey stick. It's the next 12, 13, 14 months on the outside, but it could be in the next month or two. You can't gamble there. You just keep your bet on, right? You just keep your bet on. And if you can add, you add. I mean, a lot of us can't because we're at our constraint limits. But 50, 60% of the volume on a given day is shorts trying to beat it down. When they just play it, they just play it in that range. And, at some point, the first shorts out are going to come out winners, but the last shorts out are going to be like, I just bankrupted myself. And that's what's going to happen. Just like Spire Global. I told everybody around Spire Global, back up the truck around Labor Day. And, there was doubt. Well, but it went way down. Well, yeah. If you like the company, that's when you want to buy it. And Spire Global is up, what, 150% since Labor Day? That's a pretty good investment. Metis is going to have the same thing happen. I just don't know if it's in the next couple months or if it's going to take till next year. Hard to know. What we do know is that they are going to monetize India. Yeah, he was very clear about that. So, whether they pull a 50 million or 100 million out of India, I mean, all of a sudden, people are going to have to go, oh boy, I mean, that's just going to whack the market. Nobody pays attention. It's a micro cap. Nobody pays attention. There's no coverage. 3 or 4 companies covering it. When they monetize India, oh my gosh. And then all of a sudden people are going to wake up and then you'll get your FOMO. In the meantime, you just wait for it. You just wait for it. You just wait for those dominoes to keep going over. I sold $3 puts on New York Bank Corp for April and May. So I got an average price around 3. I think one was 330, one was 240, 50, something like that. And yeah, I think that New York Bank Corp is the rare bank I want to own because it's dirt cheap. Their assets are awesome. They've got a couple hurdles to get by, but I'm just telling you right now, everything that I'm looking at based on that bank's assets, based on what the Federal Reserve wants, and based on the nature of the people who got involved, I think that New York Community Bank Corp goes through a couple of mergers and acquisitions, and it ends up becoming huge. Do you remember U.S. Bank from 15, 20 years ago? Right? They bought First Star or Star Bank out of Cincinnati, and then First Star, and then, First Wisconsin, and, they're going to become very U.S. Bank-like is what I think is going to happen. And, if you invested in U.S. Bank Corp 20 years ago and then looked at it today, would you like to look at it today? What's the symbol? Is it USB? I don't think is that right? Yeah, USB. See it on our super salad chart. Go look. Oh, yeah. Wouldn't you like to have bought U.S. Bank Corp down here? I think that's where we are on New York Community Bank. I do. That's what I think is going to happen. This is what I think is going to happen to U.S. Community Bank Corp. And it'll have some wild swings. But if you bought it here and you took it all the way out to here somewhere, how would you feel about yourself as an investor? I bet you'd feel pretty good. I think that's what's happening. And, believe me now, hear me later. Hear me now, believe me later. Whatever the saying is, right? That Saturday Night Live. Just look. How awesome is that, right? Would you not find this entertaining? I would. So I think New York Community Bank Corp is right here. I really do. All right, folks, I'll let you go. Let me get these things published. I've got a lot to publish. I got like 20 that are ready to go. I'm gonna finish them. I gotta start knocking them over. All right, take care. Oh, by the way, model portfolios coming April 1st. I know you want them. One of them is going to be the $1 million retiree portfolio. Another one is going to be the $100,000 growth portfolio. And then I'm going to do a $100,000 ETF portfolio. You have all 3. You pick how much you want from each one. How does that sound? All right, folks, have a good day, and I will try to get things published between naps because these colds have just been wiping me out. All right, take care.